Good Monday morning from our global headquarters in New York City. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. A ratings cut, stock futures, the dollar, treasuries all dip as Moody's downgrades the U.S. 30-year yields touch 5%. Moving along, the House Budget Committee advances President Trump's tax bill that could speed up cuts to Medicaid coverage. And Nvidia unveils new technologies to keep up with the boom in AI demand. Well, it is a rough morning if you are just waking up this Monday morning. Stocks, the dollar, treasuries, all of them under pressure. You can see S&P, NASDAQ, and Russell 2000 futures all more than 1%. That's after last week that the indices gained for all 5 days. We turn around. It's remarkable how quickly the narrative has pivoted from tariff deals to concerns about the budget and the Moody's downgrade. Same goes for your treasury market this morning, under pressure. I want to point out the long end of the curve because we are back at 5%, the first time since November 2023 when inflation concerns were front and center. Besides that, to get back to these levels, you have to go all the way back to 2007. I should say, again, the dollar, the euro versus the dollar at the bottom of your screen, the dollar falling basically against all of its G10 peers this morning. So those are your overall markets. Let's look at some of the stocks underneath the surface here with your stocks to watch, as always, is Bloomberg's Joe Easton. Good morning, Joe.
Hey, Danny. So we are seeing weakness across the Mag 7 today. Take a look at Tesla. We're down close to 5% on that one. Nvidia weaker as well. All of this seems to be stemming from that downgrade from Moody's, hitting the tech stocks, pushing up bond yields this morning. Then we've also got vaccines in our sight. Novavax soaring in the pre-market. We saw Asia peers rallying on reports of a spike up in COVID cases in Singapore and in Hong Kong. And we've also seen news of potentially Novavax getting approval for one of their COVID vaccines as well. So that stock, one of the best performers, up around 15%. Finally, Netflix downgraded over at JP Morgan after 2.5 years as an overweight. Now we have got Squid Game season 3 coming out in the second half of the year. I'm not sure if we need another series of that, but nonetheless, JP Morgan's reckons that the valuation is a little bit too high for that one to come down to neutral. Netflix lower 2% in the pre-market this morning, Danny.
I feel like we just got season 2. We're already getting season 3.
I know, right? We've just gotten through that one. Where else can we go with this?
Hey, if it works, it works. Netflix will keep pumping them out. Joe, thank you so much. A lot on the move this morning. Bloomberg's Joe Easton, who will catch up later in this hour. Also, in just moments, we're going to speak with Alfonso Peccatiello of Palinuro Capital. And later in the hour, we'll catch up with Lerner of Truist. And we've been talking about it so far this morning. Moody's ratings stripping the U.S. of its top credit rating agency, citing a ballooning budget deficit. Treasury Secretary Scott Bessent responded on NBC yesterday.
We didn't get here in the past 100 days. It's the Biden administration and the spending that we have seen over the past 4 years. We inherited 6.7% deficit to GDP, the highest when we weren't in a recession, not in a war, and we are determined to bring the spending down and grow the economy.
Alfonso Peccatiello of Palinuro Capital also discussing the downgrade, writing, quote, people will try now to compare the short-term bond market reaction to 2011, when the last time when the U.S. Treasury received a surprise and significant rating downgrade. Yet, the comparison makes no sense. I'm pleased to say that Alfonso joins us now. He's the founder and CIO of Palinuro Capital. Alfonso, that's exactly what we've seen this morning. People have been making that comparison. Why is it not apt this time?
Well, I would say there are a few things to consider. The first one is the broad macroeconomic situation, 2011 versus today. So in 2011, you were just coming out of the great financial crisis. You had a relatively weak US economy. Today, the story is very, very different, right? So that's the first thing. People will look at third-year bond yields and say, oh, now we got a sell-off because there's been a US downgrade. And, basically they want to make a one-to-one comparison with 2011. I would encourage people to think about the long end as a multiple layer problem. So, of course, there is a term premium. So there is the uncertainty that people want to be compensated for. And that makes a lot of sense because there is inflation uncertainty, growth uncertainty, and the policies that the Trump administration is putting through. But there is also the growth cycle and inflation cycle we're in today and the level of federal funds rate that are to be considered. And, of course, when you look at the reasons why Moody's downgraded the U.S., they're citing the fact that deficits could go to 9% of GDP. That's a very large number. I would just encourage people to understand that bond yields are not only driven by term premium, but they're also driven by today's growth and today's inflation prospects. So there is a lot to consider given the complexity of the trade policies today.
Well, you also write, Alfonso, even if that is the case, it still requires a different approach to the bond market than we had during 2012 to 2019. So what is different?
Yeah, well, what's different really is the fact that you are looking at an administration that is willing to print money for the private sector, because that's what fiscal deficits are. Those are stimulus that are coming through for the private sector through an extension of a lower tax rate, for example. And when you do that on a sustained basis, and even if you exclude interest rate costs, you're looking at 3% or more of primary deficits printed every year, you're effectively giving more fuel to the private sector, which is already running in nominal terms relatively strong. So what you are doing is effectively you're raising, I think, over the long run, the nominal neutral rate for the United States, because an economy which used to have a nominal neutral rate around 3% without fiscal deficits now probably has to have it a bit higher. The private sector in the US is deleveraged compared to 7-8 years ago. So there is less debt to GDP at the private sector level, which means the private sector is more resilient. It can afford a bit of a higher nominal neutral rate. And on top of it, you have an administration that keeps putting on primary deficits over primary deficits. So effectively, you need to expect a higher equilibrium rate. You need to expect more volatility around the level of interest rates going forward, which is a higher nominal neutral and higher term premium on top of that. That's very different than 2012, 2019.
Alfonso, I guess I'm just trying to understand the line as to what you just look at and say, this is stimulus, and you get that impact there, versus saying, this is irresponsibility. This is growing supply at a time that we've also seen foreigners start to pull back from the Treasury market. What is the line between what is just stimulus and what has gone too far, and what is too far with ballooning deficits?
Yeah, look, it's a great question. And I think the market is already trying to tell us via breaking correlations that they're not going to try and treat these deficits as they treated the deficits 7 or 8 years ago. So when you start to basically have an emerging market-like action in US bond markets and in US assets, that's when you really need to start worrying. And an emerging market-like action is basically when the US announces a deficit, and what it does is it tightens financial conditions, which means effectively you have your currency that devaluates, you have a sell-off in assets of that country. So you have bond yields up, equities down, and the currency down. This has never, ever, ever happened in the United States over the last 45 years. But even if you are the global reserve currency issuer of the world, which the US still is, and you really go for primary deficits over primary deficits over primary deficits while inflation remains sticky. That's the key point. If inflation remains sticky and the administration continues with primary deficits, we might have an emerging market-like price action in bond markets. We haven't seen it yet, but I think investors have to consider the probability this time.
And look, I know one day does not a trend make, but we're starting to see that today, Alfonso. It is higher bond yields. Stocks are selling off and the dollar is weaker too. So when you look at a 30-year yield at 5%, which is a quite rich level, again, besides 2023, the last time we saw it higher than this was 2007. How do you decide, okay, we might be heading into an environment that looks like EM versus this is a generational buy opportunity in the 30-year yield right now?
Yeah, another excellent question. So we ran a study at Palinuro where we looked at other episodes in the past where you had this trifecta that looks like an emerging market move, like we're having today. So stocks down, dollar down, yields up. And you have had 11 of these episodes, which last for about a month or so, and had a one standard deviation move in all three asset classes that we discussed simultaneously. So you've had 11 instances. The problem is that there was never a sustained follow-up. So you had this move, and it actually ended up being a great buying opportunity to come back to normality effectively, right? So what you need to see is whether this remains sustained. And really what you're saying is, if you're selling 30-year bonds at 5.02% and Fed funds are at 4.25, what you're really doing is you're paying negative carry. So unless you think the Federal Reserve is going to hike rates, which it's a little bit hard, I would say, as a scenario to imagine, you're effectively willing to pay away carry for not owning that bond that is yielding 5.03%. You need to ask yourself, is this justified? For how long can it go? Will we continue to have these policies? And to be honest, the answer is always probabilistically. I think the probability at this point in time, given the mix of policies, has never been higher over the last 40 years than you can have a sustained price action. You need to be prepared for it. And especially for portfolios is important because all the correlations that we're used to So basically you have a stock market decline, therefore you're going to have bonds rally. No, you're not going to have that. You're going to have a dollar strength with stock market declines. No, you're not going to have that. You really need to be prepared at the portfolio level, I think, for that probability to be higher than it has been over the last 40 years.
And again, that kind of preparation would really pay off in a day like today. Alfonso, this has been a masterclass. Thank you so much for joining us this Monday morning. Alfonso Peccatiello of Palinuro Capital. Let's now get some other top stories that are trending on the terminal this morning. Nvidia unveiled faster chip systems, new software, and other new tech at Asia's biggest electronics forum earlier today. CEO Jensen Huang introduced the updates and also announced a collaboration to build an AI supercomputer for Taiwan.
We're also building AI for Taiwan. And so today we're announcing that Foxconn, Taiwan, the Taiwanese government, Nvidia, TSMC, we're going to build the first giant AI supercomputer.
Shares in Alibaba, meanwhile, are sliding down 2% this morning after report that the Trump administration has raised concerns over a potential deal between Alibaba and Apple. The New York Times reporting that the White House and congressional officials have been scrutinizing a plan to make Alibaba's AI available on iPhones. Elsewhere, the latest Chinese data showed consumption undershooting expectations as retail sales growth weakened last month. Meanwhile, industrial output expanded faster than expected. Economists warned that the data highlight the need for more supportive policies. Coming up, President Trump's tax bill passes the House committee and advances to the Senate. We're going to have more on that coming up next.
Pieces yet to solve, but I think we're going to do that over the weekend. So we're moving the dials, as I said earlier. There's enough things to adjust to make it happen.
You offered them a new number?
I'm not going to tell you what I've offered. We're negotiating with a number of members, a number of caucuses, and we'll get there. So stick to it.
Do you think the negotiations are close enough to actually get something done by the end of the weekend?
I do. You know me, I'm an optimist. We move forward. We've been demonstrating that every step of the way, and we're going to do it again.
House Speaker Mike Johnson's optimism materializing over the weekend when party leaders met for negotiations. The tax bill has been approved by the House Budget Committee, but still faces obstacles. Joining us now is Bloomberg's Josh Gallo. So, Josh, at one point on Friday, this didn't look like it would pass, at least a initial vote. We got it through the Budget Committee over the weekend. Does this look likely to go through the House?
I think there are a lot of details that still need to be worked out to know exactly where it stands. Speaker Johnson, obviously, as you just showed, he's non-committal in terms of what sorts of things he's promised to Republicans to get it out of the committee. Of course, they rejected it on Friday and then came back late on Sunday and essentially abstained in order to move it through. So, you have these hardliners that are concerned about the budget deficit. They're calling for, earlier requirements for work in order to receive Medicaid. That's set to kick in the draft, not until 2029. And of course, notably after the next presidential election. They want to move that forward. That's sort of a core issue for Republicans and has been for some time. But, this bill adds $3.8 trillion in spending, and the cuts that they've already proposed are not going to cover that. So, the hardliners on the budget side, they're not yet quite happy with where this is, even though they say they've been promised some, earlier cuts to Medicaid, education, clean energy subsidies that would go some distance in making it more affordable. But on the other hand, you have people in Republicans in states like New Jersey, New York, California, who are pushing for basically more tax breaks. Like they say that the state and local tax deduction is not going to be big enough for them to support it. So I think Speaker Johnson still has a way to go to get everybody on board that he needs to in order to get a vote by Memorial Day, which is what he says he wants to do.
So once we get through that, Josh, but then we also face the Senate. What does the battle look like there?
Similarly, there are a lot of people who are holding out. Again, you're going to face the state and local tax deduction barrier that those states that I mentioned, California, New Jersey, New York, are going to be pushing for. But you also have people like Senator Josh Hawley from Missouri, who's pushing for not having these steep cuts to Medicaid. They might be able to bridge that by making it less of a cut and more of a work requirement for people on Medicaid. But, there's still a steep hurdle. So we'll have to see. The House bill that comes out is going to face a lot of changes by the Senate. And it's not clear that everybody can get on board with this, that they need to push it through. And they have this ambitious timeline of getting it to Trump's desk by July 4th, and it's going to be pretty tense negotiations all the way through.
Yeah, and it is a market that is increasingly turning its attention to budget deficits, especially after the Moody's downgrade. Josh, thank you so much. Bloomberg's Josh Galou. Just want to point out George Servelos of Deutsche Bank putting out a note just now talking about the market nervousness after the Moody's downgrade, but pointing to the fact that what is decided in the next couple of weeks will likely be locked in for the remainder of the decade, given a very difficult reconciliation process, the potential loss of Republican majority in the midterms. Again, that leaves only space, he says, for one major fiscal event, saying that the diminished appetite to buy U.S. assets and the rigidity of a U.S. fiscal process that locks in very high deficits is what is making the market very nervous. And nervous we are today. You can see futures down 1 1/3%. Okay, coming up, we're going to take a look at the other headlines around the world. What's on your front pages, including a relationship reset between the UK and EU ahead of a summit today. You're watching Bloomberg Brief. Let's take a look at the front pages this morning. First up, the Washington Post and most newspapers in the country leading with former President Joe Biden and his diagnosis of an aggressive form of prostate cancer. Biden's office said that the condition has spread to his bones, but that the disease appears to be manageable. President Trump also posted a support message on Truth Social along with other politicians. Next up, the New York Times also covering the deal struck between the New Jersey Transit and its engineers union. The agency said trains would start running again on Tuesday morning, so bad luck for you if you're commuting from New Jersey today. But even so, it resumes Tuesday morning after spending a day conducting safety checks today. And one of the most read on the Bloomberg terminal this morning about the EU and UK agreeing to terms of a post-Brexit reset for Britain. That comes ahead of a summit by both sides today. The agreement covers defense and security, geopolitical challenges, and a common understanding on a range of other issues. For more, we are joined by Bloomberg's chief European correspondent, Oliver Crook. And Oliver, we are in this moment of more optimism, let's say, around Europe. Is this another reason to be optimistic about the EU and UK?
I mean, I think the negotiators will certainly want to spin it that way. And in some ways, it is certainly progress. And obviously, what they want to do is try to expand some of the economic relationship between the EU and the UK in the absence of the United States in its sort of unpredictable status in the world right now. And this is meant to be the first step to that. So we got a little draft of this deal. We're going to get it hopefully sort of ratified a little bit later today. I'll go through a little bit of what it entails. So it's an agreement that basically includes 3 different texts, one on defense and security partnership, another one on working together on geopolitical challenge, and then another, again, sort of very ambiguously, a quote, common understanding on a range of other issues. So on the defense side of things, what could get interesting is the UK working more closely with the Europeans, potentially on joint procurement, for example, of military equipment. They will not be eligible for a lot of the European programs that Brussels has put up. But again, a lot of the sort of negotiations had to do around fishing. Danny, I know that you were sort of pleased to not have to talk about this issue anymore, having left London, but it is still a live one between the Europeans and the United Kingdom. Also freedom of movement of people, of students studying within the United Kingdom. But I think that fundamentally, Danny, the issue that you have and you always return to, this is Keir Starmer's attempt to sort of soften Brexit a little bit to try to deliver some of the economic promise between the EU and the UK without sort of crossing any sort of red lines that will upset the domestic population in the UK. And fundamentally, Danny, the difficulty with Brexit since the very beginning is it's very difficult to square that circle. So yes, a step in the right direction. How impactful it will be, I will have to see.
I don't know. I just think the British populace is going to care most that they're able to use e-gates again in Europe. I think that's what everyone's going to concentrate on. Oliver, elsewhere, on a more serious note, we are expecting a phone call elsewhere in Europe between Vladimir Putin and President Trump on Monday. What are we expecting?
So listen, what we got from Donald Trump over the weekend was this announcement that he will be speaking with Vladimir Putin at 10 a.m. Eastern time, so 4 p.m. Central European time, in order to make a sort of breakthrough in the discussions between Ukraine and Russia in terms of the possible ceasefire. Remember, this is something that the Trump administration has been putting increasingly pressure on. The Europeans got on board with it. The Ukrainians trying to get that 30-day ceasefire, with which Putin rejected last week. We had these sort of talks in Turkey that led to nowhere. And the idea now is that Donald Trump will try to break through that deadlock and try to advance the conversation around the ceasefire. We've had a flurry of diplomatic activity over the last 48 hours. We had J.D. Vance meeting with Zelensky for the first time since that Oval Office blow-up in Rome in Italy over the weekend. We had a call between Friedrich Merz, Emmanuel Macron, Keir Starmer, Giorgia Meloni speaking with Donald Trump yesterday, trying to get his ear ahead of this conversation with Putin. And all the leaders I spoke to last week at the end of the week in Albania were saying that basically Trump is Putin is just playing games, trying to buy for time as he prepares for this conversation with Trump. The question is, will he be able to break through? And for the Trump administration, no matter what happens in this phone call, this will take them closer to having to decide who the problem is. Is it Zelensky? Is it Putin? Or is the problem too complex for them to solve?
Oliver, thank you so much for your excellent coverage. As always, that is Bloomberg's Oliver Crook. Now, coming up, we'll chat with Keith Lerner of Truist on how to navigate what he calls tricky situations in markets as equities, bonds, and the dollar sell off this morning. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. A ratings cut, stocks, futures, the dollar, and Treasuries dip as Moody's downgrades the U.S. 30-year yields reach 5%. Moving along, the House Budget Committee advances President Trump's tax bill that could speed up cuts to Medicaid coverage. And Nvidia unveils new technology to keep up with the boom in AI demand. Good morning to you. It is a tough day for U.S. assets. Stocks, bonds, dollar, all under pressure. We're down 1.2% for your S&P. NASDAQ 100 and Russell 2000 underperformed, down more than 1.5%. It is a market whose narrative has quickly flipped from tariff and negotiations around tariffs to the budget isn't sustainable and a concentration on the downgrade. You continue to see yields under pressure. The front end still pinned by the Fed, but the 30-year yield goes up another 7.5 basis points. We are at 5% for the first time since November 2023, while the dollar falls against most of its G10 peers. That's your overall markets. Back with some stocks to watch. Here is Bloomberg's Joe Easton. Hey, Joe.
Hey, Danny. So we are seeing weakness across the Mag 7 this morning. Take a look at Tesla. We are down around 4% in the pre-market, pretty much driven by those macro issues with the downgrade for the US debt rating. Therefore, that move up in Treasuries hitting the tech stocks today. Nvidia was also lower. Apple as well, pretty much across the board in that space. Then we've got Novavax on the radar, a big rally in this one pre-market. There is news of an uptick in COVID cases over in Asia overnight. We've seen a spike in the illness over in Singapore and Hong Kong, lifting vaccine makers. Also Novavax getting a bit of a boost from an FDA approval for one of their COVID shots. That one probably going to be one of the biggest movers today. Then Netflix, JP Morgan downgrading the company, going down to neutral after 2 years, recommending buying the stock. Squid Game 3 coming out. We're all very excited about that. Not sure where they're going to go with that one, but given we've already had 2 series of that, but the stock getting cut at JPM. They cite the price earnings ratio as well. That stock declining 2% in the pre-market today, Danny.
Yeah, they've done already everything they can do in Squid Games. Maybe just like a whole new cast. I don't even know. Joe?
They've even had a video game as well. So
You're right. They do have a video game. Squeeze that bad boy for all it's worth. Joe, thank you so much. Bloomberg's Joe Easton. All right, so we are more than 90% into this earnings season. Corporate America has shown caution around guidance for the coming quarters, Walmart included. Take a listen to what Treasury Secretary Scott Bessent had to say about one of the largest companies in the country.
Walmart is, in fact, going to, as you describe it, eat some of the tariffs that just as they did in 18, 19, and 20. The other thing, though, that we are seeing that Doug passed along to me, that with their consumer, the single most important thing is the gasoline price. And gasoline prices have collapsed under President Trump.
Keith Lerner of Truist showing confidence in corporate America, writing, quote, U.S. companies have been battle tested through the last several years amid the highest inflation rates in decades, the fastest Fed rate hiking cycle in decades, and COVID, and they continue to outperform expectations. You got a sneak preview of him here. Keith joins us now. Hey, Keith, really wonderful to see you this morning. Look, it is this push and pull between administration that's telling companies that they shouldn't be raising their prices to Walmart saying it is inevitable. How do you see the political and both margin mix evolving after we heard from them and their earnings for most of corporate America?
Yeah, well, great to start the week with you, Danny. So, listen, I do think corporate America has actually weathered this so far pretty well. And I think there was more, even though it wasn't a blowout earnings season, relative to expectations, it was somewhat better. That said, we published a note recently, and we do think we're in a tricky situation. Back in February, we downgraded equities. We thought there was a lot of complacency. Towards the lows, you had a lot of recession built into markets. Now you're up 23% for this market. And I think the risk reward is becoming somewhat less favorable. And that's even before we saw this movement on the 10-year and the 30-year. And to your question specifically around margins, what we've already noticed is forward earning estimates for the overall market have been flatlining over the last 2 months. And now, as we hear from Treasury Secretary Bessent about profit margins may be at risk at some point. At a time, you're back to a 21.5 multiple. So you're close to peak multiples as well. So I think even though corporate America has done well, now you have a lot of good news that's being priced into markets, and you're vulnerable to something unexpected like we saw on Friday.
So what would it take you to get back to something that looks more constructive on stocks, on risk assets, Keith?
Yeah, well, as I mentioned, we were slightly underweight equity, so it's not like green light, red light, all in, all out. So we still have exposure, but for us to get more constructive, there's a couple of things. One, maybe just somewhat lower prices. Two, maybe just a consolidation of these recent heady gains. What's interesting though, Danny, is if we look back to the day after the election, we're only up 0.4% since the day after the election. So we've seen this huge volatility, but I also think we just really need to kind of move past this tariff uncertainty, and then the market starts to focus on those animal spirits again, those pro-growth policies with the tax bill, with deregulation, and maybe just some consolidation, some digestion of these gains where you correct in time and a little bit in price. That might be enough, but really at this point, we're in a holding pattern, much like the Fed is today as well.
Keith, I got to say, there is some little bit of irony because the market does seem, at least for the very short term, to have moved on from trade policy. But it's moved on to something that isn't exactly great either, and that is ballooning deficits. You can see it in the market this morning with the tax bill making its way through the House after the Moody's downgrade, where you see stocks, bonds, and the dollar all selling off simultaneously. Do you think that can last as a driver of this market, as a negative driver? Does that hurt the outlook for equities as well?
When you rebound and you're up 23% and you're back to almost peak multiples, a little bit of bad news can go a long way. And I think in this period right now, that 10-year and that 30-year, which I heard you discussing earlier, above 5%, is a concern. Because if you think about it, if you look at the earnings risk premium for the market, the inverse of the PE right now, or the earnings yield, is around 4.5%. And that's close to where the 10-year is. So you're not being compensated at the same level. And I do think that 10-year Treasury is key. And the market, to resume its uptrend that we've seen recently, is going to want to see some stabilization or some give back in that 10-year. We also know that Secretary Bessent has also highlighted the importance of the 10-year. So I'm sure they'll start to maybe jawbone that a bit more as well. But that will be really probably the key for this week.
Is it also key for tech? Because I know you were quite optimistic on tech, especially after earnings and all the capital expenditures and all the AI spending that's happening. At what point, or are we there now, that tech stocks, longer duration stocks, can't keep absorbing these higher levels of yields?
Yeah, well, tech has also just had a really big run. So even though they've been really a standout in being resilient, and that's what I really, coming out of the earnings season, the healthy spend in AI was really, something that stood out to us. That said, I think the relationship between the interest rates and tech is somewhat over-extrapolated. If we look back historically, what has been a bigger driver for tech is the relative earnings momentum, meaning if the earnings momentum is growing at a faster pace than the overall market, it tends to outperform. That earnings momentum is still there. I suspect, you've had a big move up in tech, like the overall market. I think if it pulls back a bit, you'll have some buys. But on a short-term basis, it is extended and somewhat vulnerable to these higher rates. But ultimately, I think earnings are going to be a bigger driver the outperformance. And we're overweight. We are overweight communication services, but we're also overweight utilities and financials, kind of a mix of cyclicals and defensives at this point.
Keith, I also want to go back to the idea that you mentioned that this is an administration that cares about the bond market. It's not yet clear that it is a Congress that does, that there's any fiscal discipline really coming into the conversations that we've heard over the weekend and that are going to continue this week. There was one bond market veteran who essentially said that we need something that looks like a Liz Truss moment in order to inject any sort of fiscal discipline into the market or into the conversation. And otherwise, it's not going to happen. Do you think that that is the case, that you need a large bond rupture to actually move Congress to back off of some of the deficit ballooning that they expect to do?
Yeah, it's a good question. I mean, the one thing as far as on the partisan side is Democrats and Republicans have really agreed over the last couple of years to continue to move the deficits up. So maybe that is, I think it was Winston Churchill that said the Americans will do the right thing after they've tried everything else. Like, I'm sure I messed up that phrase. But yeah, maybe you need that. But I do think there's a little bit of a wake up call. The downgrade that we saw from Moody's in itself, in our view, isn't a game changer, but it does spotlight these deficits that continue to rise. And the 10-year Treasury, as much as I mentioned before, that we can jawbone it, it does have a life of its own. It could be like kind of this bond vigilante again. So I do think it's going to become more in focus. Whether we need that Liz Truss moment is debatable, but I do think it was going to get the attention of Congress as we see these yields move higher and being spotlighted now with this recent downgrade from Moody's.
Keith, we love starting the week with you. Thank you so much for joining. That is Keith Lerner of Truist. Let's now get you some other top stories that are trending on the terminal this morning. Israeli Prime Minister Benjamin Netanyahu says the IDF is set to gain control of the entire Gaza Strip. Israeli officials are poised to order tanks and troops into Gaza in an all-out bid to destroy Hamas. Netanyahu also said that Israel will allow a basic quantity of food into the Palestinian territory after allies pressured his government to avert a famine. And a check on Alibaba shares sliding this morning by about 2%. That move follows a report that the Trump administration has raised concerns over a potential deal between the Chinese tech giant and Apple. The New York Times reporting that the White House and congressional officials have been scrutinizing a plan to make Alibaba's AI available on iPhones. Elsewhere in China, Chinese consumption data undershot expectations, with retail sales growth weakening last month. That's according to the latest national statistics. Meanwhile, China's industrial output expanded faster than expected. Beijing has been making boosting domestic consumption a priority, aiming for 5% growth target, but economists warn that the latest data suggests more support may be needed. Coming up, Trump's tax bill advances. The GOP makes a deal with hardliners despite a tough road ahead. We'll have the details for you coming up next. This is Bloomberg.
We've got a few pieces yet to solve, but I think we're going to do that over the weekend. So we're moving the dials, as I said earlier. There's enough things to adjust to make it happen.
Have you offered them a new number?
I'm not going to tell you what I've offered. We're negotiating with a number of members, a number of caucuses, and we'll get there. So stay tuned.
Do you think the negotiations are close enough to actually get something done by the end of the weekend?
I do. You know me, I'm an optimist. We move forward. We've been demonstrating that every step of the way, and we're going to do it again.
And that optimism from House Speaker Mike Johnson on Friday was not misplaced, because the House Budget Committee went on to pass President Trump's tax bill late last night. But the package still has a long road ahead. Joining us now is Bloomberg's Josh Galud. Josh, where does the bill head from here?
Well, from here, it's moving on to be debated on the House floor. And, there, as you said, it's a long road ahead. So, don't forget that it is a victory for Johnson to get that out of committee, but it was rejected on Friday. And on Sunday, when it came through, that was really because the four hardline Republicans who are really tough on deficit issues, they abstained. They didn't vote for it. They abstained. And it shows that there are several issues about how to pay for this $3.8 trillion in tax cuts over the next 10 years that are still out there. Chip Roy, for instance, from Texas, he's standing in the way. He wants there to be a work requirement for Medicaid, for that to kick in much sooner. There are other Republicans who are pointing towards curbing the subsidies for clean energy. So there are a lot of things still out there that have to be negotiated, and it's far from certain that this is going to be a straight road for Johnson.
Well, needs to head after all of that to the Senate as well. And Josh, there's a real fear among markets this morning, especially after the Moody's downgrade, that deficits are ballooning. You mentioned some of it there, but is there any really serious conversation about deficit restraint happening at the moment?
There is conversation about it. The hawks are talking about it, but the question is really, can they get this paid for? So the deficit reduction in particular is really not a focus. They're just trying to pay for these tax cuts and not add as much to the deficit. So, you know, if you talk to again, Chip Roy from Texas, they're going to be concerned about this, but are they going to stand in the way of a bill that has these massive tax cuts if it's adding less to the deficit? It seems unlikely, given that they let it pass through. Again, it goes down to their core demands on some principles and to their districts about what they'll support. But overall, I don't think we see any real movement in lowering the deficit over time. The Republicans also have walked back some ideas about raising taxes on the most wealthy. That appears not to be the case. And at the same time, the projections are not for great growth in the coming quarters and this year. So, you know, deficits have really not been as much a topic as you would think after the downgrade.
All right. Thank you so much. That is Bloomberg's Josh Galou with the latest coming out of Washington, D.C. By the way, even though stocks are selling off this morning, Mike Wilson of Morgan Stanley writing that you should be buying any dip fueled by the Moody's downgrade, saying that the odds of recession are lower after that U.S. and China trade deal, making stocks a buy. Now, speaking of stocks selling off, Nvidia is among them. The shares are lower in the pre-market this morning, largely driven by all of Mag 7 falling, with bond yields on the long end going above 5%. But elsewhere, we did have the CEO, Jensen Huang, unveiling faster chip systems, new software, and other new technology at the Computex event in Taiwan.
This year, in Q3, we'll upgrade to Grace Blackwell GB300. The GB300 will increase the same architecture, same physical footprint, same electrical and mechanicals, but the chips inside have been upgraded.
Let's get more with Bloomberg's Charlie Wells. Charlie, overshadowed this morning what we heard by what's happening elsewhere in markets. But was there any inclination whether this is enough to kind of make up for some of the market share loss, some of the demand loss coming from China restrictions?
Yeah, Danny, that's a really good question. And I think one of the key themes here is just kind of the different vibe of this show versus prior years. And there have been a lot of announcements coming out. I think the most striking here, and maybe the most consequential, is NVLink Fusion. That is a new version of a system that would allow NVIDIA customers to deploy rivals chips in systems ultimately based on NVIDIA's technology. And that is a big opening up of NVIDIA systems. And I think that speaks to the themes that we're really seeing here at this conference, where it's less about this exuberance, this excitement about the newness of AI, and more about attempts to try to entrench it in systems to justify it and to maintain, at least in NVIDIA's case, their lead over rivals that is increasingly under competition.
There's competition and there's pressure from policy, and you see it really abundantly clear in tech. Even just this morning, Charlie, Alibaba shares have been falling. I think they're down about 2%, or they fell about 2%. There seemed to be that New York Times report on Trump concerns about Alibaba and Apple's deal. What were the details there?
Yeah, Danny, so this comes at a difficult moment for Alibaba. They just reported a worse than expected earnings report. And so this indication that the Trump administration has been looking into a potential deal between Alibaba and Apple for Apple to deploy AI services in China. Now, this is not great news for Alibaba, but it is also bad for Apple because Apple needs a local partner in China in order to roll out these all-important AI features on its iPhone. The Chinese market is the second most important for Apple after the United States, and these features are a key way for Apple to try to compete in that hot Chinese market where there are a lot of other competitors, there are a lot of other AI participants, and so this is not great for Apple, not great for Alibaba. Remains to be seen how it will all shake out, but this is certainly putting both of those companies under pressure right now.
Charlie, thank you so much for your reporting this morning. That is Bloomberg's Charlie Wells. Now, earnings season continues on. We heard from Ryanair citing robust demand, higher ticket prices in Europe. Bloomberg's Tom McKenzie spoke with CEO Michael O'Leary following the results from the airline.
I was written to by some US lawmaker asking me not to guarantee that we won't buy Chinese aircraft, and I wrote back politely saying, go to hell. I'm not giving you, we will reserve the right to buy aircraft wherever we so wish. We remain
not certified yet, COMAC.
No, they're not certified and won't be certified for another 5 or 10 years. But I've been written to by some congressman in the US whose iPhone was made in China, asking Ryanair not to guarantee not to buy Chinese aircraft.
Yeah.
We would give no such guarantees. I mean, I don't see any great prospect of us buying a COMAC aircraft. The Boeing are making great aircraft. You look at our numbers this morning, an awful lot of which are being driven by the Boeing MAX 8200s. Those aircraft offer us 4% more seats. They're burning 16% less fuel. They're transforming our economics. And I think you add those new aircraft to the declining cost of oil for the foreseeable future. And I think not just Ryanair, but the airline sector in general looks set for 2 or 3 years of reasonably strong earnings.
Talk to us about the oil price. I mean, you're seeing prices now about $62 a barrel on Brent. You hedge around oil prices. Are you hedged to the upside, or are you well protected on lower prices?
No, I mean, we hedge straight for jet fuel into plane. We were hedged in the last year. So the results this morning, we were hedged at $79 a barrel. We're 85% hedged this year at about $76 a barrel, about a 4% fuel saving. We took advantage of the uncertainty post the Trump tariffs or Independence Day, whatever it was last month. We hedged about 40% of summer 2026 fuel at about $66 a barrel. This is jet. Jet at the moment, spot is about 67, Brent is 62. That's about a 13% saving on fuel into next year. Our annual fuel bill is about $5 billion. So if we could hedge out the remainder of next year at $66 a barrel, you're looking at savings of between $700-800 million going straight through to the bottom line, which would create an enormous opportunity for Ryanair to really meaningfully lower the cost of air travel across Europe next year.
Ryanair CEO Michael O'Leary speaking with Bloomberg's Tom McKenzie. O'Leary also speaking on the analyst call at the moment, saying that they can avoid tariffs by taking jet deliveries in the UK. So you see this real attempt by companies to try to adjust and try to adapt, even if they are based in Ireland. Okay, coming up, we're going to get you set up for your week ahead. We'll take a look at your trading diary next on your Bloomberg Brief. It's your Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading week on this Monday. JP Morgan's Investor Day conference, that will be kicking off at 8 a.m. Eastern. Then President Trump is scheduled to speak with President Putin of Russia at 10 a.m. to discuss how to end the war in Ukraine. And then Lowe's and Target report earnings. That happens on Wednesday. Just want to give you a quick look at markets as we head to the end of the hour, because you have this mix that Alfonso Peccatiello was describing as one as very EM-like. That is, you get rising deficits, and the reaction is tighter financial conditions across the board. We are selling off. Your 30-year yield, that is back above 5%. We're up by more than 7.5 basis points this morning. The last time we had above 5%, it was 2023. We're in the throes of inflation. But we did hear from Mike Wilson of Morgan Stanley saying that any dip related to that Moody's downgrade in stocks you should be buying. And a dip we are having this morning, down 1.2%. His argument that we have less of a chance of a recession because of the China-U.S. trade deal. Therefore, stocks are a buy. All right, that is it for your Bloomberg Brief. Surveillance is up ahead on this Monday morning. This is Bloomberg.